Hey guys, Brian Stevens here with Mortgage Shots and the National Real Estate Post. I'm also a loan officer at the Loan Factory. Hey, listen, if you want to know what our team is doing, by all means, reach out to me, give me a call. There's my phone number right over there. Send me a text message, that might be better, or you can obviously put it in the comments down below, or hit me up on Instant Message on Facebook or direct message on Facebook, and we can go from there. But listen, we have a big issue on our hands right now. Oh, shit. Sorry about that if you're here right now. 1, 2. We're going to move this over here like this. Yeah, if you're watching this on YouTube right now, you're getting what is going to get edited. You're getting the raw version of what's getting edited tomorrow. This is what goes into it. Take 2. Hey guys, Brian Stevens over here with Mortgage Shots and the National Real Estate Post. Today we are going to be talking about a white paper that the Brookings Institute did, and it is quantitative easing and the effects that it has on housing prices. This is a huge issue that I think our policies were going down the wrong road right now, and this needs to be discussed. The only ones who might be interested mildly in having this conversation are the boots on the ground in the real estate and the lending community. So I'm hoping to give you guys a little bit of light over the next couple of days as to what this actually means. The Brookings Institute has done a great job with this. Of course, I've got other sources that we're going to be discussing, but this is going to be the backbone of our discussion on our show for the next couple of days. We're going to be taking it in bite-sized pieces. I hope every loan officer and real estate agent in this country uses this as an opportunity to go out and have a much more meaningful conversation or dialect with people around you so we can get a groundswell to change our policies so we don't go down a road that is going to see an outcome that, frankly, we're all too familiar with. We've seen this in other countries right now where they've had massive inflation, hyperinflation, effects on their currency, foreign investment, and that has led to all the indicators that we generally look at as a means of really forecasting the direction all markets are going to go. The bond market, the treasury market, the stock market, all the indexes, and of course, the housing market. So without further ado, let's jump into this right now and see if we can go ahead and shed some light on this. Okay, quantitative easing in home prices, how the Federal Reserve policies have negatively impacted affordability. The first thing we're looking at here is the Nikkei. Why are we starting off in Japan when we're talking about the United States housing market? Well, what we're doing here is we're looking at 1965 to 1923, what we're looking at here is 1965 to 2023. You'll notice a precipitous, massive tectonic increase in the Nikkei that started in the early 1980s. In the early 1980s, the Japanese economy was going gangbusters. It was going absolutely crazy. Foreign investment was pouring into the country, and the cost of real estate went through the roof. In fact, the Japanese market, which is a fraction of the size of the United States housing market, actually overcame for a small amount of time and became more valuable, in spite of its smaller size, more valuable than the United States housing market. That trend has since subsided, and you'll notice from that massive peak near the middle on the left-hand side of this graph that you're looking at right now, you'll notice that what went up significantly and drastically came collapsing, cascading back down shortly thereafter. Now, this happened in 1990, well, it ended in about 1992 or 1993. But from the years 88, 89 to 93 in Japan, you can imagine they were going through what was really a significant recession. And it was all built on the shoulders of the housing market. And that's what I really want to convey to you. On the right-hand side, what you're looking at right now is the home price to income, or our debt-to-income ratios in the United States housing market. And we are suffering from the same unaffordability that Japan was suffering back in the 1980s. However, the conditions of our market are drastically different than what was taking place in Japan. For example, their industry was gangbusters. Their exports were far exceeding their imports. Their surplus was insurmountable, and it had no peers in the global economy. As a result of this, foreign investors went and invested in the yen, the Japanese currency, increasing the value of its currency. And of course, they were investing in Japanese land. And of course, the property values in Japan went through the roof, just as the Nikkei did. In fact, if we were to pull up Japanese values, as we did on yesterday's show, and you can go back and look at that, the graph is going to look very similar to what the Nikkei is. Now, in most markets, what you have to understand is rates increase in hot markets. They don't decrease in hot markets. So in Japan, rates were going through the roof back in the 1980s as property values were going through the roof. The reason for this is quite simple. There was massive demand for a limited supply of money. And what this did is it pushed the price of money up. It pushed the price of money up, and that materialized itself in the form of higher interest rates, alongside property values getting more expensive. Now, this makes perfect sense. In a declining market where people aren't buying and we take away the demand, then we have a surplus of supply. When we have a surplus of supply and people are not borrowing money, the value or the cost of that money goes down, and we realize this in the form of lower interest rates. So as a general rule of thumb, what we see is property values going up with rates going up, and the market tempers itself. Does that make sense? Now, here's the conundrum. Over on the right-hand side, we're looking at debt-to-income ratios, and this has a complete and total parallel to home values and interest rates in this country. However, we have the exact opposite effect, opposite of what we saw in the 2008 housing meltdown as well. We see property values going through the roof as rates are coming down. Property values are through the roof right now, and we can see that from the home price to income ratios. That means our ratios are going up. That means affordability is disappearing. So what we have done to combat this is we have tried, or the Federal Reserve has tried through a number of different ways to lower rates. Now, when the Fed lowers their prime rate, what happens there? It lowers the rate for everything but mortgages. It lowers your installment payment interest rates that you're going to pay along with your credit cards, or so it's supposed to be. Not necessarily the cases we're feeling right now. So the Fed is about to embark on something that they haven't done for a number of years that we are still suffering the ill effects of, and that is quantitative easing. Now, on the right-hand side, what we spoke about yesterday, I want you to look at this here. We go above the 50-year average of debt-to-income ratios, a grand total of 1, 2 times that you're looking at here. In truth, we're going back to 1975. This graph goes back to 1960. We have 4 times over the past 60 years where we have seen our average debt-to-income ratios get above the median. And each and every time it did this, we saw debt-to-income ratios plummeting, and they plummeted because prices on houses came crashing back down. Again, the opposite of what we're seeing in Japan right now. We are using quantitative easing as a means to spur the housing market, because as the United States housing market goes, so does the rest of the world economy, and it's not having the effect that we want. So come back in with quantitative easing as a solution for which we already know we have no positive outcome. In the 1980s, real estate increased by over 500% in the Japanese market. The market grew to twice the value of the United States market. Can you believe that? Even though Japan is 5% of the area in the United States, by 1989, stock prices reached 40,000 after starting the decade at 6,500. You want to talk about a boom period? Japan saw this in spades compared to anything that we've ever seen, and they saw the ill effects from their government's policies. Share volume more than doubled, and the system entered into what we all know as a bubble. So the question we have to ask ourselves, my friends, are we in a bubble? Now, I want you to look at our market right now, and this is just going to validate the points that I already brought up to you. You're looking at a graph right now that shows mortgage rates and change in average home values on a quarterly basis from 2012 to 2025. So if we look at let's just take the 2022. That's when we saw our low rate environment, and we saw property values going through the roof. These are going to be on your far right hand side. You see this top orange dot? We had a rate of nearly 6%, but we had a low down here of about 2 5/8. That would be 2.65%. So most of the home value escalation that we saw between April of 2020 to March of 2022 came in a low rate environment, bucking the trend of how every single housing market has worked in every single country, everywhere around the world. Does that make sense? Because if we go to 2012 to 2020, prior to that, you'll note, again, that is part of our quantitative easing. We saw values lower, we saw interest rates lower, and we saw a significant change. But if we go over to the far right-hand side, we have the same low-rate environment, but it's not having the same effect on property values. Home appreciation tends to coincide with an increase in rate environment. More demand for more mortgage pushes the price of money upwards. This is realized in rising interest rates. This market is behaving the exact opposite of what it should be doing. Now, why is that the case? So from the Brookings Institute, I have a couple of things highlighted that I want to share with you, and I want us to discuss it. And of course, if you have any questions or any thoughts on this, feel free to put it in the comments down below. It's always helpful for us over here. The rise in home prices was a major contributor to the inflationary episode. Understanding this, housing boom is critical for policymakers to connect the consequences of their actions. Note the term consequences of their actions, because what we have here are unintended consequence, a term that I've been using for the past 2 decades since I've been video blogging about the mortgage and real estate markets. What we've seen is our policymakers have guessed wrong in terms of what the intended outcome is going to be based on their policies. So what they're saying here is understanding the housing boom is critical for policymakers to connect the consequences of their actions, as we have not done in the past, particularly as it relates to the relationship between inflation and quantitative easing. Quantitative easing, by the way, is where the Federal Reserve is going to go out there, they're going to take their balance sheet and they're going to buy mortgage-backed securities, and they're going to buy them in droves. In fact, I will show you from the Brookings paper here that there was a moment when we were buying upwards of 90% of all mortgage-backed securities through the Federal Reserve. When we do this, we create a false market, a false demand for mortgage-backed securities. And when we create a massive false demand, what does it do? It drives the cost down. It should be, when we buy more mortgage-backed securities, it should be driving the price down. This paper examines the impact of quantitative easing undertaken by the Federal Reserve from 2020 to 2022, during which the Fed's mortgage-backed securities MBS purchases were a whopping $1.33 trillion. It was equal to nearly 90% of the growth in the mortgage-backed securities market. Well, this is massive. So what we do is we're buying all of these up. We're buying more, so we have more. So we have more supply than we have demand. We have more supply. We have more supply with money than the demand for mortgage-backed securities. And what this does is it irrationally and disproportionately drives the price of that commodity down. In our case, that commodity is money, and we realize it in the form of lower interest rate. The rise in housing prices was a major contributor to the inflationary episode. Understanding this housing boom is critical for policymakers to connect the consequences of their actions, particularly as it relates to quantitative easing. Okay, moving on. In the initial period following the onset of the pandemic, the Federal Reserve, the Fed's monetary policy response was to cut interest rates to the zero lower bound, activate a series of emergency lending facilities to support a wide array of financial assets, and engage in quantitative easing. So I don't know if you know this, but the Federal Reserve legally only has certain moves that they can make with the tools at their disposal that have been allowed or been given to them and mandated by congressional approval. One of the things that they can do is they could buy bonds, they could buy mortgage-backed securities. This is the course of how do I put this? This is the least desirable and the action of last resort, because after quantitative easing, the Fed has spent all of their bullets and there's nothing else that they can do. Now, the last time we went down this road of quantitative easing, we saw rates get down to 2.5% and 3%. And what it did last time around, and this is going to be right around COVID, is it created a massive demand for mortgage-backed securities at these artificially lower interest rates, and people were buying houses based on rates in the 2s and the 3s when money was very cheap. Now, the second time around, we're not having the same effect. We are dropping interest rates once again, but people are not coming off the fence. People are fixated on the 2s and the 3s, and sellers don't necessarily want to sell, and buyers are waiting for a better market, a market which cannot come back because it is irrational to think that we are going to have interest rates in the 2s and 3s in perpetuity. If we did, it would be okay. But if we look at the 30-year fixed rate mortgage average interest rate over the course of the past 60 years, it's going to be hovering somewhere around 7%. So if the norm is 7, we can't create artificial massive demand in the 2s because once we go back up to the 7s, it creates a problem. What we're seeing right now, and this should have the red lights flashing in front of your face right now, Aruga, something's wrong, danger, Will Robinson, that type of thing, is we are engaging in quantitative easing and we are not getting the same results we had last time. In short, the United States housing market is in for a rude awakening. Post-recession, the Fed began rising interest rates, ended its emergency lending facility, and stopped quantitative easing. We stopped it, and the housing market, what did it do? It died, it flatlined, dead in its tracks, and we cannot, up until this point, pull out the defibrillators and do anything to get it going again. The recovery from the COVID pandemic brought the highest inflation the United States has seen in decades. Annual growth of the Consumer Price Index, also known as the CPI, reached 9% in 2022. This is really important, guys. Because of all the money that we put into circulation, it was about a third additional to existing U.S. dollars that are in global circulation. We added a third to it, which dilutes every other dollar. When we create inflation, we devalue the money that we currently have, and it effectively works as a pay cut for everybody across the board. So exacerbating the problems we have right now, not only are home prices more expensive than they've ever been, not only are we buying these at higher interest rates than we have over the course of the past 7 or 8 years, but on top of that, we're dealing with inflation both inside and outside of housing, which is stressing people's pocketbooks. The house is more expensive, the rates are higher, and my dollar doesn't go as far. Not to mention, after I buy this house, I'm going to have to deal with deferred maintenance on the property, which is very expensive. And I'm also going to have to go out there and get food and gas and energy and all the other consumables that keep us moving on a day-to-day basis, all of which have gone up in price because of the inflationary market we haven't seen since the 1980s. And again, if you want to hear more about that, you can go watch my show yesterday, and we talk a little bit about what Volcker did in the 1980s to really stave off inflation for 4 decades. We find ourselves again engaging in bad policies, and again, these bad policies has brought back inflation. And this is the pain at the pump that we feel, proverbially speaking, with every asset and every facet, of our lives. The recovery from the COVID pandemic brought the highest inflation the United States has seen in decades, since the 1980s, when Volcker was the head of the Federal Reserve. Annual growth of the Consumer Price Index, the CPI, reached 9% in 2022, as we just discussed. At the Fed's 2024 Jackson Hole Economic Symposium, Federal Reserve Chairman Jerome Powell gave a list of reasons for inflation in the United States. Now, get a freaking load of this. He said, the supply chains, they're shocked right now because everybody's sheltering in place because of COVID. Speed of demand snapback post-pandemic is dragging its ass right now. The Russian invasion of Ukraine, of course, this is affecting inflation in the United States. And a tight labor market because we have such great employment. That employment that we have are people working 2 and 3 jobs as we do not have a history for in numbers that we have never seen. And that is what has tightened up the labor markets. It's not that people are working a healthy 9-to-5, 8-hour-a-day job. It's a lot of these, particularly the younger generations who are trying to fight inflation, are working 2nd and 3rd jobs. And that's giving us the false reality that the labor markets are tightening. They're tightening for all the wrong reasons that frankly are unsustainable. But the most important thing that we learned from the Jackson Hole Economic Symposium from the Federal Reserve Chief Jerome Powell is that housing was completely absent altogether from his list. How in the hell is that even possible? The largest component of the United States economy is housing. And by extension, it's the largest single facet of the global economy that affects not only what takes place in the United States, but all markets across the world, as foreign investors are huge in the United States housing market, both in buying houses and mortgage-backed securities. What you're looking at here is the annual change in the consumer price index of all items and main housing items monthly seasonably adjusted from 2012 to 2025. Do you note anything here? Does anything jump out at you? If we look at all items, which is going to be the darkest line, that's the second highest peak. All items less shelter. All items less shelter, we're looking at the consumer price index over this period jumping a massive 10% over a very short period of time. 9%, all items including housing. Tenant rents jumped a massive amount. It jumped 9%. And owner equivalent versus rent, of course, that one's at the bottom. But that massive jump on the right-hand side is what is taxing the pocketbooks of every American and keeping people on the outside looking in when it comes to buying houses and really pushing the lifeblood of the United States economy, which is the housing market. When people stop buying and people stop selling, there is no way, I repeat, no way to get out of a recession. August 2023, the Federal Reserve Bank of San Francisco projected that shelter inflation, that's where we live, was likely to slow. It really did, predicting a steady decline of shelter inflation reaching 0% growth in the mid-2024, which is about where we're at. Instead, shelter inflation remained elevated, increasing by 5% annually in mid-2024 and 4% in mid-2025. If actual shelter inflation had followed the San Francisco Fed's projection, overall CPI growth would have been below the Fed's 2% target rate in 2024 instead of being above it. This is because of bad policies, guys. This is because of the policies that the Fed has been following, artificially dictating the direction we're going. Given the Fed's decision to keep interest rates elevated until September 2024 due to persistent inflation, it is quite possible that housing inflation decreased as the Fed projected, or even at the same time and rates as the rest of the economy. The Federal Reserve may have begun to cut interest rates a month or two earlier, and we would have seen something that would have otherwise been a positive effect. Okay, so this is a really interesting point I want you guys to follow. The GFC's epicenter was Americans' housing finance system, with a combination of poorly underwritten, highly leveraged mortgages leading to a boom and bust of America's housing. As part of the response to the GFC, the Fed initiated quantitative easing back in 2008. Okay, so we know what took place in 2008, right? What we had a housing market that was wildly hot, and it was all funded by loans that had start rates in the 1s and the 2s and the 3s. Now, the big problem there was all of these loans had prepayment penalties on them. We saw loans that had prepayment penalties of 3 years, but that low start rate of 1, 2, or 3% was going to adjust in 2 years. Meaning, whoever took out that loan that was rated AAA was going to invariably have a year where their interest rate and their payment was going to go through the roof. You would go from a 2% rate to a 12% rate, and you were stuck paying the mortgage on that 12% interest rate for that full year, or you're going to have to do a refinance and deal with a prepayment penalty, which is going to amount to 6 months interest on the property. Now, a lot of folks back then were churning houses. They're churning their house. They were refinancing it on a regular basis, and they were actually eating these prepayment penalties. And when they ate the prepayment penalties, they were losing their false equity at a record pace that we had never seen before. As a result of this, we found houses in a escalating valued market. We saw people upside down when that was an irrational option and one that the Federal Reserve didn't even consider. Nobody thought folks would get into the position to where they were going to churn their loans and eat 6-month interest prepayment penalties over and over again on an annual basis. But when you write a loan for somebody who can't afford it in the first place, that becomes the most reasonable response to your dilemma, is to refinance it and keep the house and bet on the fact that the market is going to continue to go up. Provided the market continued going up, everything was going to be okay. But once you get a hiccup, the entire house of cards was going to come falling down, which is exactly what it did. That, my friends, is a definition of a bubble. We are in another bubble right now, but this one is drastically different. As then Fed Chairman Ben Bernanke stated, in using the Federal Reserve's balance sheet as a tool for achieving its mandate objectives of maximum employment and price stability, they didn't get price stability. They got price appreciation at a level that has never been seen in this country. The Federal Reserve Open Market Committee has focused on the acquisition of long-term securities, specifically treasuries and agency securities, which are the principal types of securities that the Federal Reserve is permitted to buy under the Federal Reserve Act. Remember, I told you a moment ago that there are only certain tools available that the Federal Reserve can use to go ahead and manipulate our economy. By and large, they have stayed on the sidelines, not trying to get into the game. But with the 2008 once-in-a-lifetime meltdown, we had to come in and make decisions. Those decisions, though we got through it, proved not to be the best decisions on the table. I don't begrudge the Federal Reserve for making bad decisions back in 2008 because we didn't know what tomorrow brought. We didn't know if it was going to collapse the entire banking system altogether and we would find ourselves not in a recession, but in the greatest depression we'd ever seen. I don't begrudge any of these folks who did this stuff. However, making similar moves today, knowing what the previous outcome is, seems not only foolish, it seems irresponsible. Treasury and mortgage debt markets are the largest debt markets in the United States. It is the biggest market in the United States housing market. The Treasury market reached $36 trillion, while the mortgage market is over $9 trillion. That is a huge number, most of which in your origination or your real estate lifetime has been fully funded by the United States Treasury, courtesy of the buyout of the government-sponsored enterprises, another story for another day, and the Federal Reserve by trying to manipulate our market to accomplish, what did they say a couple of moments ago? They said that they were doing this. Where is it at? Leading to a stabilization of the market. That's essentially what they are trying to do, and we missed that completely. The second point here is this. The Treasury and mortgage debt markets are the largest debt markets in the United States. The Treasury market, as we know, we got that one there. Okay, Grant, cut that one out. So what we're looking at here is ownership of Treasury securities quarterly from 2004 to 2025. Who's buying our debt? And why is this a global epidemic? And what only is happening with the United States housing market has far-reaching effects on investors in all countries all across the world. You can see down there at the bottom, that is the Federal Reserve. They are one of the largest holders of mortgage-backed securities. Other United States government agencies, that would be the darker blue above it. Above that, and the largest component of the United States Treasury market is foreign investment. That would be your orange. Above that, your lighter orange is going to be mutual funds. This is what you invest in. Above that, a small portion is going to be our banks. Even smaller portion is going to be our state and local governments. Then, of course, insurance, saving bonds, and others. Now, the Fed's share of agency mortgage-backed security holdings from 1995 to 2024, let's check this out. Foreign mortgage-backed security holders at the bottom are 1.4%. Commercial banks and mortgage-backed security holdings, 2.9%. The Federal Reserve is at 2.4%. A total agency mortgage-backed securities is sitting at 9.1. Oh, excuse me, these aren't percentages. Yeah, right. These are trillions. Let's try it again, Grant. Foreign mortgage-backed security holdings are $1.4 billion, a massive number. Oh, let's try it again, Grant. Foreign mortgage-backed securities is $1.4 trillion. Of course, you know that a trillion seconds is 36,000 years. A billion seconds is 36 years. A billion seconds is 36 years. A trillion seconds is 36,000 years. So when we talk about billions and trillions very flippantly, understand that it's not. It is significantly more money. Commercial banks, they hold $2.9 trillion. The federal mortgage-backed securities, we hold $2.4 trillion, and total agency mortgage-backed securities that are outstanding right now are a whopping $9.1 trillion. trillion, yes, trillion dollars. So let's just put this in perspective, guys. How large was the Fed's purchase in this market? How large was the Fed's purchase in this market? The Fed's ownership of $2.7 trillion of agency mortgage-backed securities in 2022 was 32% of the entire $8.5 trillion mortgage-backed security market. That's a big number. 32%. During the 2020-2022 quantitative easing period, total agency mortgage-backed securities increased by $1.5 trillion, of which the Fed purchased $1.33 trillion. In short, from 2020 to 2022, virtually all mortgage-backed securities were bought by the Fed, and this is where we saw our irrational, disproportionate low mortgage interest rates in the 2s and 3s, creating a false market for which we're still suffering the ill effects from, a market that we are going back into. Listen, I'd rather have one more bad year, than 10 more pretty damn bad years. Goes something like this. If you had to chop your arm off, bear with me here, and you had the choice between a butter knife and an axe, you might be inclined to take the butter knife because you think it might not hurt as much. You can kind of work your way through it. But once you get down to those tendons, you'd be begging for the axe. We have a butter knife effect to how we're dealing with our dilemma. We're taking what is going to be difficult and we're amortizing it out over a decade period with the policies that we have right now. I, for one, would like to deal with it right now. If we steer clear of quantitative easing, if we allow rates to maintain where they're at right now, we will get back to a market of normalcy where people are buying and selling based on a market that is set of rates in the 6s, 7s, and maybe even the low 8s, rather than a bunch of sellers who are expecting a market to get back down to 2% and buyers who are expecting a very similar market. That's never going to happen again. And think about this for a moment. If we get 2s again, what's going to happen? Sure, people are going to come out of the woodwork. People are going to continue buying houses. They'll bid the property values up even higher than they are right now, and we will eventually get back to our norms. Our norms are going to be those rates in the 6s and 7s. And once that happens, we can look at another decade, a lost decade, where real estate doesn't move, bringing a freeze to not only the United States housing market, but the United States economy, and by extension, even the global economy, because I just showed you how much foreign investment actually goes into the United States market. And I got to tell you, when we deal with trillions of dollars, the United States can actually kind of handle it. Our economy is half of the world's GDP. Yeah, we can kind of take it. But when you consider Iceland and the Scandinavian countries and England and France and even Japan and China could probably handle it. When they're investing to the tune of billions and trillions of dollars, this could torpedo their economies as well, which of course will have ripple effects that come back to our shores. The Fed's mortgage-backed security purchases were equal to nearly 90% of the growth in the mortgage-backed securities during this quantitative easing period. So now we are going back into QE. Do you want quantitative easing? I, for one, think we're better off without it. More on this topic coming. Please tune in and share this and keep the conversation going. And let me know what you think about quantitative easing. Yeah, we all like the idea of low rates tomorrow, but I don't like the idea of a lost decade of mortgages because I don't have too many decades left in me. With that said, folks, you make it a great day, and I can't wait to see you again until tomorrow. Thank you.